Introduction: Technical Analysis of the Financial Markets. Welcome to Technical Analysis of the Financial Markets by John J. Morphy. In this introduction, the author explains what technical analysis really means and why it's one of the most powerful tools for traders and investors. Technical analysis is the study of market action, mainly through charts, to predict future price movements. In simple terms, it focuses on what the market is doing rather than why it's doing it. Morphy describes three key principles that form the foundation of technical analysis. First, market action discounts everything. This means that all known information, whether economic, political, or emotional, is already reflected in the price. So, by studying the price itself, we can understand the complete behavior of the market. Second, prices move in trends. Markets don't move randomly. They move in trends upward, downward, or sideways. Once a trend begins, it's more likely to continue than to suddenly reverse. Third, history tends to repeat itself. Why? Because human nature doesn't change. Emotions like fear, greed, and hope drive market behavior, and these emotions create patterns that repeat again and again. Morphy also tells us that technical analysis can be applied to any market, whether it's stocks, commodities, currencies, or bonds, because all markets are driven by the same human psychology. He reminds us that charts are the trader's most valuable tool because they clearly show how supply and demand interact. In conclusion, Morphy says that technical analysis is both a science and an art. It provides a structured, logical way to study price behavior, but it also requires intuition, experience, and judgment to master. And that's what this book is all about, helping us understand how markets move, how trends form, and how we can read the story that prices tell. Lesson 1: The Basic Concepts of Technical Analysis. From Technical Analysis of the Financial Markets by John J. Morphy. Welcome to Lesson 1: The Basic Concepts of Technical Analysis. In this chapter, John Morphy helps us understand the foundation of how technical analysis works and why it is such an important tool in the world of trading and investing. Technical analysis is the art and science of studying price movements through charts in order to forecast future trends. It is based on the belief that everything that affects a market's price, whether it's earnings, news, politics, or emotion, is already reflected in the price itself. That means, instead of analyzing a company's financial statements or economic data, a technical analyst focuses only on price, volume, and time. Morphy explains that technical analysis stands on three main pillars. Pillar 1: Market action discounts everything. Every possible factor that can influence price, company performance, government policy, global events, and even trader psychology is already built into the market price. The chart reflects all of it. So, a technical analyst simply studies how price behaves, not why it behaves that way. Pillar 2: Prices move in trends. Prices don't move randomly, they follow trends. A trend means the general direction in which the market is moving up, down, or sideways. Once a trend starts, it usually continues in the same direction until signs of reversal appear. Traders who can identify and follow these trends early can profit the most. Pillar 3: History repeats itself. Human emotions like fear, greed, and hope never change. That's why market patterns tend to repeat over time. By studying past price charts, analysts can recognize familiar patterns and use them to predict what might happen next. This is where chart patterns, like head and shoulders, double tops, and triangles, become powerful tools. Morphy emphasizes that technical analysis is not magic. It's a logical system that helps traders understand the ongoing battle between supply and demand. When demand is greater than supply, prices rise. When supply is greater than demand, prices fall. Charts simply help us see this battle more clearly. He also reminds us that technical analysis applies to all financial markets, stocks, bonds, commodities, and even currencies, because human psychology drives all of them. Lesson 2: The Doe Theory. From Technical Analysis of the Financial Markets by John J. Morphy. Welcome to Lesson 2: The Doe Theory. This lesson introduces one of the oldest and most respected foundations of technical analysis, a theory that shaped the way we understand trends in the financial markets. Blue Book. What is the Doe Theory? The Doe Theory was developed from the writings of Charles H. Doe, the founder of the Wall Street Journal and co-founder of Dow Jones and Company. Even though it was created over 100 years ago, its ideas remain timeless and relevant in today's modern markets. John Morphy explains that the Doe Theory is not a set of trading rules, it's a philosophy about how markets behave and how trends are formed. 1. The market has three movements. According to Doe, the market always moves in three directions at the same time, like waves within waves. The primary trend. This is the main direction of the market and usually lasts for 1 year or more. It's the big picture, the major bull market or bear market movement. The secondary trend. These are temporary corrections that move against the main trend. They last from a few weeks to a few months. Think of them as the market taking a breather before continuing in the main direction. The minor trend. These are short-term daily or weekly fluctuations that traders often see as noise. They last for a few days or even hours. Doe compared these trends to tides, waves, and ripples in the ocean. 2. The market has three phases. Each major trend, whether bullish or bearish, passes through three distinct phases. For a bull market, the phases are: accumulation phase. Smart investors start buying when most others are pessimistic. Prices are low and the market sentiment is negative. Public participation phase. The trend becomes visible and more investors join in. Prices rise faster, volume increases. Excess or distribution phase. Everyone is optimistic now. The smart investors start selling to the latecomers at high prices. For a bear market, the same phases happen in reverse. 3. The averages must confirm each other. Doe created two main market averages: the industrial average and the transportation average, originally railroads. According to Doe, a major market signal is valid only if both averages confirm each other. For example, if the industrial average makes a new high, but the transportation average does not, the signal is weak. True confirmation happens when both move in the same direction. 4. Volume confirms the trend. Volume should increase in the direction of the trend. In a bull market, volume rises on upswings and falls during corrections. In a bear market, volume rises on downswings and declines during rallies. This shows the strength or weakness behind price movements. 5. A trend remains in effect until a clear reversal occurs. A trend continues in its direction until there are clear signs of a reversal. Temporary fluctuations or small corrections do not mean the trend has ended. Doe believed traders should stay with the trend until it proves it has changed. Hello everyone. Welcome to Lesson 3 of Technical Analysis of the Financial Markets by John J. Morphy. In this lesson, we'll learn how charts are constructed and why they are the foundation of all technical analysis. Bar chart 1. Purpose of charts. Charts are visual pictures of market movements. They show price action over time, helping traders identify patterns, trends, and signals. In simple words, charts convert market psychology into a picture so you can see what buyers and sellers are doing. Chart with upward trend 2. Types of price charts. There are mainly three popular types of charts used in technical analysis. A. Line chart. Simplest type of chart. It connects closing prices with a continuous line. Used to get a clear overall view of the market trend. Disadvantage: it hides details like highs, lows, and opening prices. Speaking head in silhouette example. If you just want to know whether the stock is going up or down over time, the line chart is enough. B. Bar chart. The most common chart in technical analysis. Each bar shows 4 key prices: opening price, high price, low price, closing price. This is often called the OHLC chart. Speaking head in silhouette tip. A long bar shows high volatility. A short bar means the price didn't move much that day. C. Candlestick chart. Originated in Japan. Each candle shows the same 4 prices, OHLC, but in a more visual and colorful form. The body shows the open and close. Wicks show highs and lows. If the closing price is higher than the open, it's a bullish candle, often white or green. If the close is lower, it's a bearish candle, often black or red. Speaking head in silhouette. Why traders love it. Candlestick charts are easy to read and show market emotion, fear and greed more clearly. Tier of calendar 3. Time frames. Charts can be drawn for different time periods. Intraday, minutes or hours, for short-term traders; daily for swing traders; weekly or monthly for long-term investors. Speaking head in silhouette. Remember, the longer the time frame, the stronger the signal. Bar chart 4. Volume. Volume is the number of shares or contracts traded in a given period. It confirms the strength of a price movement. If the price rises with high volume, the move is strong. If the price rises with low volume, it might be weak or temporary. Round pushpin 5. Importance of scaling. There are 2 main scales used on charts. Arithmetic scale, equal distance between prices. Best for small price moves. Logarithmic scale, each equal distance represents the same percentage change. Best for long-term and large price changes. Left pointing magnifying glass 6. Summary of the lesson. Charts are the visual tools of technical analysis. Line, bar, and candlestick charts each have their uses. Volume and time frames add depth to your analysis. Understanding scaling helps you interpret price moves correctly. Direct hit conclusion. Charts are not just pictures, they are the language of the market. Learning to read them is like learning to read a story about fear, greed, and opportunity. In the next lessons, we'll learn how to identify trends, support, and resistance using these charts. Lesson 4. Understanding the trend. Hello everyone. Welcome to Lesson 4 of Technical Analysis of the Financial Markets by John J. Morphy. In this lesson, we'll learn about what a trend is, how it forms, and why it's the most important concept in technical analysis. Chart with upward trend 1. What is a trend? A trend simply means the direction in which prices are moving. If prices are moving continuously upward, downward, or sideways, it's said that a trend exists. John Morphy says, White right pointing backhand index, the trend is your friend until it ends. That means, as long as the trend continues, Trade with it, not against it. Bar chart 2. Types of trends. There are three main types of trends in the market. White down pointing backhand index. A. Uptrend. When prices make higher highs and higher lows continuously. It shows that buyers, bulls, are in control. Also known as a bull market. Speaking head in silhouette example. If a stock moves from 100 rupees, 120 rupees, 140 rupees, 160 rupees, it's an uptrend. B. Downtrend. When prices make lower highs and lower lows. It shows that sellers, bears, are dominating. Also known as a bear market. Speaking head in silhouette example. If a stock falls from 200 rupees, 180 rupees, 160 rupees, 140 rupees, it's a downtrend. Large white square. C. Sideways trend or range-bound market. When prices move between a fixed range, neither up nor down. Buyers and sellers are equally strong. Also called consolidation or range trading. Speaking head in silhouette example. If a stock keeps moving between 100 rupees and 110 rupees, it's a sideways trend. Tier of calendar 3. Duration of trends. According to Morphy, trends can be classified by time duration. White down pointing backhand index. One key cap primary trend lasts for more than a year. Shows the main market direction. 2 key cap secondary trend lasts for a few weeks or months. It's a correction or pullback within the main trend. 3 key cap minor trend lasts for a few days or weeks. Represents short-term fluctuations. Speaking head in silhouette. Remember, big trends are made up of smaller trends. Straight ruler 4. Drawing trend lines. The simplest way to identify a trend is by drawing trend lines. Uptrend line connects to or more higher lows. Acts as a support line. Downtrend line connects to or more lower highs. Acts as a resistance line. Speaking head in silhouette tip. The more times a price touches the trend line and reverses, the stronger that trend line becomes. Chart with downward trend 5. Trend reversal. When the trend changes. When prices break a trend line or fail to make a new high or low, it signals a possible trend reversal. Speaking head in silhouette example. If in an uptrend, prices stop making higher highs and start making lower highs, it could mean the uptrend is ending. Bar chart 6. Channels, price channels. If we draw a parallel line to the trend line on the opposite side of the price movement, we form a price channel. There are 3 types of channels. Ascending channel, rising upward descending channel, sloping downward horizontal channel, moving sideways. Channels help traders identify support and resistance zones within a trend. Direct hit 7. Lesson summary. A trend shows the direction of price movement. There are 3 types of trends: uptrend, downtrend, and sideways. Trends can last for different durations: primary, secondary, and minor. Trend lines and channels help identify and confirm trends. A trend reversal occurs when the price pattern breaks or changes direction. Conclusion. Identifying trends is one of the most important skills in trading. When you trade with the trend, your chances of success increase significantly. Always remember, white right pointing backhand index, don't fight the trend. Follow it. In the next lesson, we'll learn about support and resistance, the key tools to understand where prices stop and reverse. Here's Lesson 5, Support and Resistance, from Technical Analysis of the Financial Markets by John J. Morphy. Microphone Lesson 5, Support and Resistance. Hello friends. Welcome to Lesson 5 of Technical Analysis of the Financial Markets by John J. Morphy. In this lesson, we are going to learn about two of the most powerful and basic concepts in technical analysis: support and resistance. These two levels help traders understand where prices stop, where they reverse, and how to find entry and exit points in the market. Direct hit Part 1. What is support? Support is a price level where the buying pressure is strong enough to stop the price from falling further. In simple words, support acts like a floor under the price. Whenever the price falls and reaches this level, it tends to bounce back upward. Speaking head in silhouette, for example. If a stock keeps falling but every time it touches 100 rupees, it goes up again. Then 100 rupees becomes the support level. That's the point where buyers are ready to enter the market. Direct hit Part 2. What is resistance? Speaking head in silhouette, now let's talk about resistance. Resistance is a price level where the selling pressure is strong enough to stop the price from rising further. It acts like a ceiling above the price. Whenever the price goes up and hits this level, it usually falls back down. Speaking head in silhouette, for example. If a stock rises but drops every time it reaches 150 rupees, then 150 rupees becomes the resistance level. That's the point where sellers come into the market. Direct hit Part 3. The psychology behind support and resistance. Speaking head in silhouette. Support and resistance are not just about numbers. They are about human emotions. At support levels, traders believe the price is low or cheap, so they start buying. At resistance levels, traders feel the price is too high, so they start selling. This emotional reaction of fear and greed repeats again and again. And that's what creates strong support and resistance zones on the chart. Direct hit Part 4. Role reversal. When support becomes resistance. Speaking head in silhouette, a very interesting thing happens in the market. Once a support level is broken, it often becomes a new resistance level. And once a resistance level is broken, it often becomes a new support level. Speaking head in silhouette, for example. If a stock breaks above 150 rupees, which was resistance before, and stays above it, then 150 rupees becomes its new support. This is called role reversal. And it's one of the most important principles in chart analysis. Direct hit Part 5. Trend lines as support and resistance. Speaking head in silhouette, support and resistance are not always horizontal. They can also move with the trend. And that's where trend lines come in. In an uptrend, the trend line below the price acts as support. In a downtrend, the trend line above the price acts as resistance. These are known as dynamic levels, because they change with time as the trend continues. Direct hit Part 6. Importance of volume. Speaking head in silhouette, volume plays a key role in confirming support and resistance. If prices bounce from support or fall from resistance on high volume, then that level is considered strong and reliable. Speaking head in silhouette, remember, the more times a level is tested without breaking, the stronger that level becomes. Direct hit Part 7. Breakouts and false breakouts. Speaking head in silhouette, when price moves above resistance or below support, it's called a breakout. It signals the possibility of a new trend. However, not all breakouts are real. Sometimes, prices break a level and quickly return. This is called a false breakout or a fake move. Speaking head in silhouette, smart traders always wait for confirmation, like a retest of the level or a move with high volume, before entering a trade. Direct hit Part 8. Lesson summary. Speaking head in silhouette. Let's summarize the key points of Lesson 5. White heavy check mark support, a price level where prices stop falling and buyers step in. White heavy check mark resistance, a price level where prices stop rising and sellers appear. White heavy check mark, these levels represent market psychology, fear and greed. White heavy check mark, when broken, support becomes resistance and resistance becomes support. White heavy check mark, trend lines also act as support and resistance. White heavy check mark, volume confirms the strength of these levels. White heavy check mark, breakouts signal the start of new trends, but watch out for false ones. Direct hit conclusion. Speaking head in silhouette, support and resistance are the foundation of technical analysis. They help traders see where buyers and sellers are likely to take action. When combined with trend lines, volume, and chart patterns, they become powerful tools for decision-making. Always remember, white right pointing backhand index, support shows where buying begins, and resistance shows where selling starts. In the next lesson, we'll learn about price patterns, like head and shoulders, triangles, and flags, which help us predict the next big market move. Here's the Lesson 6, Price Patterns, Summary from Technical Analysis of the Financial Markets by John J. Morphy. Microphone Lesson 6, Price Patterns, Script Format. Intro Scene Calm Confident Tone. Speaking Head in Silhouette. Hello friends. Welcome to Lesson 6 of Technical Analysis of the Financial Markets by John J. Morphy. In this lesson, we will explore one of the most powerful tools in chart reading. Price patterns. Price patterns help traders identify when a trend is continuing or reversing, and they give clues about the next possible market move. Let's begin. Direct Hit Part 1. What are price patterns? Speaking Head in Silhouette. Price patterns are specific formations on a chart created by the movement of price. They show the battle between buyers and sellers and help predict which side is likely to win next. These patterns can be divided into two main types. 1. Keycap reversal patterns, which signal a change in trend direction, and 2. Keycap continuation patterns, which signal the trend will keep going. Chart with downward trend. Part 2. Reversal patterns. Speaking Head in Silhouette. Let's start with reversal patterns. They show when an existing trend, either up or down, is about to end or reverse. Here are the most common ones. White down pointing backhand index. A. Head and shoulders pattern. Speaking Head in Silhouette. This is one of the most famous reversal patterns. It usually forms at the top of an uptrend. It has three peaks: the left shoulder, the head, the highest point, and the right shoulder. The line connecting the lows of these peaks is called the neckline. When price breaks below the neckline, it signals a trend reversal. The market may start moving downward. Inverse head and shoulders. This is the opposite version. It forms at the bottom of a downtrend and signals that prices might start rising again. Large blue circle. B. Double top and double bottom. Speaking Head in Silhouette. These are simple yet powerful reversal patterns. A double top occurs when price reaches a high level twice, but fails to break it both times, signaling the end of an uptrend. A double bottom happens when price hits a low level twice and bounces up, signaling the end of a downtrend. Once the neckline, the middle level, is broken, the trend usually reverses direction. C. Triple tops and triple bottoms. Speaking Head in Silhouette. Similar to double tops and bottoms, but here, price tests the same level 3 times. These patterns confirm stronger resistance or support levels before the trend reverses. Chart with upward trend. Part 3. Continuation patterns. Speaking Head in Silhouette. Now let's look at continuation patterns. These patterns appear during a trend, when the market pauses or consolidates for a while, and then continues in the same direction. Here are the main ones. White down pointing backhand index. A. Triangles. Speaking Head in Silhouette. Triangles are among the most common continuation patterns. They show a period of indecision between buyers and sellers. There are three types of triangles. 1. Keycap ascending triangle, higher lows with a flat top, usually bullish. 2. Keycap descending triangle, lower highs with a flat bottom, usually bearish. 3. Keycap symmetrical triangle, both highs and lows converge. Breakout can go either way. When price breaks out of the triangle, it usually continues in that direction with strong momentum. B. Flags and pennants. Speaking Head in Silhouette. These are short-term continuation patterns. They appear after a sharp move, like a flagpole. A flag looks like a small rectangle slanting against the trend. A pennant looks like a small triangle. Both represent a short pause before the trend resumes. Example: if a stock jumps sharply upward, forms a small flag, and then breaks out, it usually means the uptrend will continue. C. Rectangles, trading ranges. Speaking Head in Silhouette. A rectangle forms when price moves between parallel support and resistance lines. It shows that the market is in a temporary pause. Neither buyers nor sellers are dominant. Once price breaks out of the rectangle, it often continues in that breakout direction. Direct hit part 4, the psychology behind patterns. Speaking head in silhouette. Every price pattern represents the psychology of traders. Their fear, greed, hope, and hesitation. When the pattern completes and price breaks out, it signals that one side, either buyers or sellers, has finally taken control. That's why successful traders always wait for a breakout before confirming the pattern. Direct hit part 5, volume confirmation. Speaking head in silhouette. Volume is an important factor in confirming patterns. During pattern formation, volume usually decreases, showing indecision. But when the breakout happens, volume should increase sharply, confirming that the move is real and strong. Direct hit part 6, measuring price targets. Speaking head in silhouette. Price patterns can also help traders estimate targets. The height or width of a pattern can be measured and projected from the breakout point to estimate how far the next move may go. Example: if a triangle is 20 rupee high, then after breakout, the price often moves another 20 rupees in that direction. Direct hit part 7, lesson summary. Speaking head in silhouette. Let's quickly recap what we learned in lesson 6. White heavy check mark price patterns show battles between buyers and sellers. White heavy check mark to main types, reversal and continuation. White heavy check mark head and shoulders, double tops bottoms reversal signs. White heavy check mark triangles, flags, and rectangles continuation signs. White heavy check mark volume confirms breakouts. White heavy check mark measuring the pattern helps estimate price targets. Direct hit conclusion. Speaking head in silhouette. Price patterns are like the language of the market. Each shape tells a story of emotion, pressure, and change. By learning to recognize these patterns, you can predict the next possible move in the market with greater confidence. Always remember, white right pointing backhand index patterns repeat because human behavior never changes. In the next lesson, we'll study volume and open interest to understand how they confirm price movements and strengthen trading signals. Here's the Lesson 7, Volume and Open Interest Summary from Technical Analysis of the Financial Markets by John J. Morphy. Microphone Lesson 7, Volume and Open Interest, Script Format. Speaking head in silhouette. Hello friends. Welcome to Lesson 7 of Technical Analysis of the Financial Markets by John J. Morphy. In the last lesson, we learned about price patterns, how the movement of prices forms patterns that tell us about the market's next possible direction. In this lesson, we'll focus on two very important supporting indicators: volume and open interest. Both of these help confirm whether a price move is strong or weak, and whether the trend is genuine or false. Let's begin. Direct hit part 1, Understanding volume. Speaking head in silhouette. Volume simply means the total number of shares or contracts traded during a specific time period, such as a day, week, or month. It shows the level of activity in the market. When volume is high, it means there is strong participation. Many traders are active, and interest in the market is high. When volume is low, it means fewer traders are participating, and the move might not be strong or reliable. Chart with upward trend part 2, the role of volume in trend confirmation. Speaking head in silhouette. Volume helps us confirm trends. John Morphy emphasized a simple rule. White right pointing backhand index, volume should expand in the direction of the trend. Let's understand this with examples. In an uptrend, volume should increase as prices rise, showing strong buying interest. In a downtrend, volume should increase as prices fall, showing strong selling pressure. If volume shrinks while the price continues moving, it could be a warning that the trend is losing strength and may soon reverse. Bar chart part 3, Volume in different market phases. Speaking head in silhouette, let's see how volume behaves in various stages of a market trend. 1. Key cap at the beginning of a new trend. Volume is usually low but starts to increase as more traders notice the move. 2. Key cap during the middle of the trend. Volume remains strong, confirming the health of the trend. 3. Key cap at the end of a trend. Volume may suddenly spike as traders rush in. This often signals exhaustion and a possible reversal ahead. Chart with downward trend. Part 4. Volume and price relationship. Speaking head in silhouette. The relationship between price and volume tells us the quality of a move. Here are a few key principles. White down pointing backhand index. White heavy check mark, price up plus volume up is equal to bullish confirmation. White heavy check mark, price up plus volume down is equal to weak rally. White heavy check mark, price down plus volume up is equal to bearish confirmation. White heavy check mark, price down plus volume down is equal to weak decline. This combination helps traders understand whether a breakout or breakdown is trustworthy or false. Chart with upward trend. Part 5. Understanding open interest. Speaking head in silhouette. Now let's discuss open interest, which applies mainly to futures and options markets. Open interest, or OI, means the total number of outstanding contracts that are still open and active at the end of the trading day. If you buy one futures contract and someone sells it to you, open interest increases by 1. If either of you later closes the position, open interest decreases by 1. So, open interest shows how much new money is flowing into the market. Electric light bulb. Part 6. Using open interest with price. Speaking head in silhouette. Just like volume, open interest helps confirm the strength of a trend. Let's understand the combinations. Price action. Open interest action. Meaning, price plus OI. New money entering, trend is strong. Price plus OI. Short covering, trend may end soon. Price plus OI. New short positions, strong downtrend. Price plus OI. Long liquidation, trend may weaken. In simple words, open interest tells us whether fresh positions are being added or old ones are being closed. Direct hit. Part 7. Volume and open interest together. Speaking head in silhouette. Volume and open interest, when studied together, give a complete picture. Volume tells us how active the market is today. Open interest tells us how much commitment there is in the market overall. If both are rising along with price, it confirms that new money is supporting the trend. A strong bullish sign. If both are falling, it means traders are losing interest, and a trend change could be near. Left pointing magnifying glass. Part 8. Divergences. Speaking head in silhouette. Sometimes, we see a divergence between price and volume or open interest. That means the two are moving in opposite directions. For example, if price is making new highs, but volume is not increasing, it's a warning signal that the rally may be weak. Similarly, if open interest declines while prices rise, the uptrend may be losing strength. Direct hit. Part 9. Lesson summary. Speaking head in silhouette. Let's quickly recap what we learned in Lesson 7. White heavy check mark, volume measures market activity and participation. White heavy check mark, rising volume confirms the trend's strength. White heavy check mark, falling volume warns of weakening momentum. White heavy check mark, open interest shows the total number of active contracts. White heavy check mark, increasing OI means new positions are being added, strong trend. White heavy check mark, decreasing OI means positions are being closed, possible reversal. White heavy check mark, combining volume plus open interest gives a clearer picture of market strength. Direct hit. Conclusion. Speaking head in silhouette. Volume and open interest act as the heartbeat of the market. They show the energy behind every price move. Remember, price tells you what is happening, but volume and open interest tell you how strong that move really is. In the next lesson, we'll study moving averages, one of the most popular and powerful tools in technical analysis, to identify and follow market trends. Here's the Lesson 8 Moving Averages Summary from Technical Analysis of the Financial Markets by John J. Morphy. Microphone. Lesson 8 Moving Averages, Script Format. Speaking head in silhouette. Hello friends. Welcome to Lesson 8 of Technical Analysis of the Financial Markets by John J. Morphy. In the previous lesson, we studied volume and open interest, the heartbeat of market strength. Now we move to one of the most important and widely used tools in technical analysis: moving averages. Moving averages help traders identify trends, smooth out price noise, and generate buy-sell signals. Let's dive in. Direct hit part 1. What is a moving average? Speaking head in silhouette. A moving average, MA, is a line on the chart that shows the average price of a market over a selected period of time. It moves because with every new price bar, the oldest data point is dropped and the newest one is added, keeping the average continuously updated. In simple words, it tells us the direction of the trend, whether the market is going up, down, or sideways. Chart with upward trend part 2. Purpose of moving averages. Speaking head in silhouette. Markets are full of short-term ups and downs, or what we call noise. A moving average smooths out these random fluctuations so we can see the underlying trend more clearly. White right pointing backhand index. When prices are above the moving average, the trend is generally up. White right pointing backhand index. When prices are below the moving average, the trend is generally down. Bar chart part 3. Types of moving averages. Speaking head in silhouette. John Morphy explains two main types of moving averages. A. Simple moving average, SMA. Speaking head in silhouette. It's the most common type. You add up the closing prices for a certain number of periods, say 10 days or 50 days, and divide by that number. Each day has equal weight in the calculation. Example. A 10-day SMA adds the last 10 closing prices and divides by 10. Large blue circle. B. Exponential moving average, EMA. Speaking head in silhouette. EMA gives more weight to recent prices and less to older ones. That means it reacts faster to price changes. Traders prefer EMAs when they want quick signals, especially in fast-moving markets. Tier of calendar part 4. Common moving average periods. Speaking head in silhouette. Different traders use different time frames. Short-term, 10-day or 20-day mass. Medium-term, 50-day mass. Long-term, 100-day or 200-day mass. Tip. The 200-day MA is one of the most watched indicators worldwide. When prices are above it, markets are considered bullish, below it, bearish. Chart with downward trend part 5. Moving average crossovers. Speaking head in silhouette. Crossovers are powerful trading signals. White right pointing backhand index. Bullish crossover. When a short-term MA crosses above a long-term MA, it signals a potential uptrend, a buy signal. White right pointing backhand index. Bearish crossover. When a short-term MA crosses below a long-term MA, it signals a possible downtrend, a sell signal. Example. The 50-day MA crossing above the 200-day MA is called a golden cross, bullish. The 50-day MA crossing below the 200-day MA is called a death cross, bearish. Bar chart part 6. Moving averages as support and resistance. Speaking head in silhouette. Moving averages often act as dynamic support and resistance levels. In an uptrend, prices may bounce off the MA line, acting as support. In a downtrend, prices may fall back from the MA line, acting as resistance. Traders watch these levels to plan entry and exit points. Gear part 7. Advantages and limitations. Speaking head in silhouette. White heavy check mark. Advantages. Easy to use and understand. Clearly shows trend direction. Reduces short-term noise. Cross mark. Limitations. It's a lagging indicator. It reacts after prices move. Gives false signals during sideways or choppy markets. That's why moving averages work best when the market is trending, not range-bound. Chart with downward trend part 8. Combining moving averages with other indicators. Speaking head in silhouette. Moving averages become even more effective when combined with other tools, like volume, momentum indicators, or price patterns. For example, if a bullish crossover happens with increasing volume, it confirms that the uptrend is strong. Direct hit part 9. Lesson summary. Speaking head in silhouette. Let's quickly recap lesson 8. White heavy check mark. A moving average shows the average price over time and smooths out fluctuations. White heavy check mark. SMA gives equal weight to all prices. White heavy check mark. EMA gives more weight to recent prices, faster response. White heavy check mark. Crossovers provide buy-sell signals. White heavy check mark. Mass can act as support and resistance levels. White heavy check mark. They lag behind price and may give false signals in sideways markets. Direct hit conclusion. Speaking head in silhouette. Moving averages are the foundation of trend-following systems. They don't predict, they confirm. Remember this golden rule. White right pointing backhand index trade in the direction of the moving average. When you combine moving averages with volume, momentum, and price patterns, you get a complete and powerful picture of the market trend. In the next lesson, we'll learn about oscillators and momentum indicators, tools that help traders identify overbought and oversold conditions.